and you didn't go, if you close a client and you didn't go through the education on how bad group life is, how bad trash value or terrible term is, you're going to have to pay for it in the back end. And that is with a Charlie Brown, if you guys don't know what that is.
All right. Because, I was talking to Josh the other day and, he kind of gave me an honest assessment of his appointment. And he said, I kind of felt like I could have just went right to the term, given a quote, gotten a close. And then in the appointment, he found out that not the client, but the trainee that he was working with had whole life. And because he had taken the time to present it, even though the client didn't have it, they weren't looking for it, because he presented why it was bad, the trainee actually figured out that that's what she had. So, and Josh and I also had an interesting conversation about, success is repetitive. Success is redundant. If you read books from famous basketball coaches, football coaches, it's all about the fundamentals, right? Every practice, you're going to have to, practice layups. You got to practice all kinds of drills. These are professional athletes and they warm up, taking layups. And so Primerica, if you do 2-3 appointments in a day, if you're very busy, if you're doing the interview, sometimes, and even me, right, probably especially me, you look for shortcuts, right? I value my time. I think I'm probably, I think I'm good, maybe better than I am. And I go right for a close. But at the end of the day, these things are built in for a reason and it can come back and bite you. So she's going to pull up her presentation today and we're going to talk about all the different scenarios that someone can have when it comes to life insurance. And then she's going to show us how she quotes and closes. So that's why we didn't have any other speakers today, because I want to get this recording out there and everyone's asking for this and I don't want her to be cut off because of time, right? So Jen, why don't you go ahead and share your screen?
Okay, I need permission to share screen first.
Sure. There you go.
Okay. So this is before I transition into the life close. Do you want me to go over anything here?
Yeah, you can start on this one and then transition into the other one. Yeah.
So I love this slide because it allows us to go straight into life insurance. So I went over it again yesterday. I won't go into detail, but when I asked, isn't it true? When I asked, doesn't it make sense that we address the income protection or income being protected properly first before we address other concerns? The client's always going to say yes, because you just explained that the most important or strongest part of a physical house is the foundation. And they agreed with you. So that's the purpose of this. And as soon as they say yes, then you go into, okay, so how much coverage do you currently have, Samir? So what scenario do you want me to go over, Samir? Because there's either they'll have no insurance.
Well, because you've gone on the most appointments in your market, in your experience, what is the most common scenario?
Group insurance, no insurance.
Okay. So you can choose whichever one.
Okay, perfect. So just pretend you have whatever coverage through your job and you say you have 100,000 or something.
Okay, perfect.
Okay, so how much coverage do you currently have, Samir?
I have 100,000.
Okay. Do you feel overinsured, underinsured, or not sure?
100,000, probably underinsured.
Underinsured. And is this through your job or outside of your job?
It's through my job.
Okay, that's fine. You probably already know how it works, but I still have to help Joey know how to explain how life insurance through the job works. So I'm just going to go over employer coverage really quickly, okay?
Sure.
So let's pretend that this is your job insurance benefit and this is your document and you also have a family attorney. And you take this to the family attorney and you say, Mr. Smith, Can you please review this document for me and my children? Because if God forbid something happens to me, this is the only thing they have to depend on. So this is a really important document. So what the attorney's going to say is, Samir, it's good you have something, but through your job, through any job, you're not the policy holder or the policy owner. Your job or employer is the one who owns that benefit on all the employees. So in this case, a state of Maryland government employer, if you work for them, and if they own that benefit on you and they wanted to change anything or freeze anything, guess what they can do, Samir?
They can do it.
Yeah, because can the certificate be amended? Yes, we retain the right to amend the certificate at any time without your consent. On top of that, what is the actively at work requirement? To be eligible to become insured or receive an increase in the amount of insurance, you must be actively at work, fully performing your customary duties for your regularly scheduled number of hours at the employer's normal place of business or other places the employer's business requires you to travel. If you are not working due to illness or injury, COVID or disability, you do not meet the actively at work requirement. Termination coverage ends on the earliest of the following: the date the group policy is amended, so you are no longer eligible, or the date the group policy ends. So this is not our client I'm getting ready to share, but this proves the same point.
Well, she knew her husband was dying.
And so I played the video, side note. So I played the video, guys, and let's fast forward. The video is done.
The Williams still cannot collect on the $250,000 life insurance policy. Live in Frisco, Steve Stoller, Channel 8 News.
Isn't that crazy, Samir?
Yeah, it is.
Yeah. See, the moral of the story is the attorney is going to say, don't ever, 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 ever solely depend on your life insurance through your job, because when it comes to your family, how much risk do you want to take?
None.
Right. Can you see why we always recommend you have private cover so you have full control over it?
Yes.
Awesome. So when you go private, there's only two choices that you can choose from. One is cash value life insurance, mostly known as whole life or universal life. And then the other one is term. As you can see, they're not apples to apples comparison at all, because one combines insurance protection and a supposed savings inside, and the other one is just protection. Can you see how it's not apples to apples?
Yes.
Yeah. So I'm going to go into cash value really quick, because in the cash value policy, it sounds good, but in the contract, it's illegal for them to call it actual savings. So they have to call it another name, which is cash value. And that's a red flag, isn't it?
Yep.
So when you pay extra into this type of policy, the savings component works like this. And these are very easy questions, so you're going to know the answer. But when you put your money in any bank, would you prefer your money earn a higher rate of return or a lower rate of return?
Obviously, a higher rate of return.
Right. Once your money is in the bank, would you prefer your money belongs to you, it's liquid, you take it whenever you want, or you have to borrow your own money from them and pay it back with interest?
Liquid.
Right. And you know how some families fight over money when somebody does pass away?
Yeah.
Would you rather your family or children still have the money passed to them? Or would you rather Bank B say, oh no, Samir, we don't want your family to fight, so we'll do you a huge favor. We'll just keep all your savings. We'll pay the insurance, but we'll keep all the savings. That way they don't have to fight.
Yeah, I'd rather be passed on to my survivors.
Right. Anybody being asked those questions that directly, always pick Bank A. But when it comes to dealing with somebody who's just a life insurance agent, not a full-fledged financial advisor like us, they always try to get you to go into Bank B. And it's like buying a pair of shoes and you only see one shoe in the shoebox. What would you call that?
Ripoff.
Exactly. And you would never knowingly put your money into an account that works like Bank B, would you?
No, never.
Right. But if you knew anyone who had a Bank B type of policy, how quick would you want them to find out?
As soon as possible.
Exactly. Now, by the way, have you ever heard about Dave Ramsey or Susie Orman?
Yeah, I've heard of Susie Orman.
Okay, so Dave Ramsey is the male version of her. He's a public financial advisor just like she is. So this is what he says about whole life. Okay, so side note, fast forward, the video's done. He sees how horrible cash value is. And
out these other great clips from the show.
That's crazy also, right, Samir?
Yeah.
Yeah, so don't ever, 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 ever listen to anybody that tries to tell you there's savings inside a policy. That's just not right. So what we do is we follow, again, Dave Ramsey and Susie Orman. Susie, as you know her, says most of us only need a life insurance policy for a set period of time until the toddlers are adults and supporting themselves, or until we have time to build up our own assets. So unfortunately, not all term is created equal. Other companies will offer you a term, but do you think they'll sit down and help you become financially independent and save enough money where one day you don't have to pay them anymore?
No, probably not.
No. So they're going to give you a very low quality term and then try to convert you later to cash value, again, where you're paying 10 times more. Even if you wanted to renew the term, they would make it very unaffordable. Like at State Farm, we also call them Snake Farm, by the way. This is a 20-year term on husband and wife in their 30s. They have 1.5 million on him, 1.2 on her, and they pay only $138 a month. Doesn't seem bad, but in the fine print, it says after the first 20 policy years, premiums increase significantly. These premiums continue to increase annually for both husband and wife until it looks like this. From $1,600 a year to paying $55,000 a year. Would you ever pay that, Samir?
No, I couldn't.
Exactly. And even if you could, they would make you reprove your health most of the time to even keep that going. However, what are the chances you will be healthier or will be healthier in the next 20 years?
Yeah, probably not likely.
Right. So with us, we call ourselves a one-trick pony, meaning if you pay for a show, the pony only has one trick. It better be a good trick, right?
Right.
Yeah. So with us, we only specialize in term when it comes to life insurance. After that, we talk about getting you financially independent and out of debt, etc. So we have the best term in the industry. Why? Because we have a terminal illness rider up to 70%, which means, let's say you have $100,000 with us of coverage. 70% of that is $70,000 of cash you could take out to pay for the best medical treatment. Hopefully you don't need it, but sometimes the difference between living and dying when you have cancer or COVID, the difference is money, isn't it?
Right.
Right. We're also rated A+ on AM's Best, third-party rating company. Out of 200 rough companies that existed during 9/11 when the planes crashed, can you believe only 3 of them paid out?
Wow.
That's crazy. And we were one of those 3. So we don't believe in competing on price or cost or name brand. We believe in competing on how we deliver to our families. And last year it got so bad when COVID took a lot of lives. Remember that?
Right.
That Yahoo Finance had to come out with an article titled 7 life insurers likely to overcome COVID. And there's about 700 life insurance companies that exist now. So only 7 as of this year in January got listed able to overcome COVID. And guess who made the list of 7?
Wow.
Big deal, isn't it?
Yeah.
Yep. So not my favorite bragging right is that 93% of our claims are paid within 14 days, 2 days on record. You know, we meet your beneficiary and your emergency contacts. In case something happens to you, they know our process and our company. For example, I've been here for quite some time now, and I've had the unfortunate pleasure of delivering a couple death claims already. And Reggie was one of my clients. He became a client with his wife in July 2017. In October, they were getting ready to divorce. And in November, he changed his beneficiary to his daughter, Barbara. I met with Barbara because she's the beneficiary. So she knew who we are, our process, and I have a relationship with her. I left the house after 10 minutes of meeting with her. But in the next month in December, her dad passed away of a heart attack on the job. Within 2 hours, she called my cell phone. She never, ever, ever, Samir, had to call 1-800-PRIMERICA. And the same day she called me was the same day I came to her with the paperwork. We paid out, in his example, $100,000, no questions asked. He was my client for less than 6 months.
Wow.
And we hand delivered that to her. My vice president came out of his retirement days to hand deliver that to her with me. Isn't that a big deal?
Yeah, definitely.
So you can see why you should have coverage with our company, right?
Yep.
Yep. So typically when a responsible parent like yourself doesn't have any coverage in place outside of their job, usually it's one of these following 3 reasons. Either 1, You didn't think you needed it. Like, no, I don't care about my kids. I know that's not you, so we can scratch that off. Two, maybe you didn't think you could afford it privately. Or three, you didn't get around to it. Maybe just classic case of procrastination, like most human beings do. But which one best describes you?
I just didn't get around to it.
Okay, so we can definitely get around to it today. But is protecting your family important enough where you would be willing to begin setting aside some money each month to take care of this?
Yes.
And if we could put together a program that would be affordable for you, it fits in your budget, and you're comfortable with it, is there any reason you wouldn't implement that program?
Probably have to talk about it.
Okay. Let me ask you, who would you need to talk about it to? Because I know it's just really you with your children, right?
Yeah. Yeah, I guess.
Okay. And let me ask you, when you say you guess, this is something important for you to protect your family with. Is that what I'm hearing?
Yes, it is important.
So typically when somebody, kind of responds like you respond, there's a couple of things they still need to think about. What are some questions that maybe you have that you need to think about?
Just how maybe your cost compares to other companies.
Okay, that's okay. Well, listen, a lot of people think that insurance is more expensive than it actually is, especially compared to, when you look at other companies' quotes. But we have policies that fit within your budget. However, I don't want you to think that you're spending more money than you already are. Remember, about a couple minutes ago, you just mentioned that you spend an easy $20 a day, and that's $600 a month. I don't want you to spend $600 a month towards life insurance. I definitely don't want you to do that. But I do want you to use some of that money that you're using for chips, soda, coffee, and move it over, just reallocate it to something that's more important, just like your children. At the end of the day, your children are more important than your bag of chips every day, aren't they?
Yeah, of course.
Yeah. So again, if I could put together a program that doesn't take you away from too much of your leisurely spending and is still affordable for you and you're comfortable with it, is there any reason you wouldn't implement that program for your family?
No, I guess not.
Okay. Has anybody ever calculated the amount of coverage you actually need?
And I think that's an important, pause here is a lot of times when people don't get the response that they want, or they're not getting a commitment to move forward, they move forward anyways, and then they wonder why the client didn't actually purchase or implement the plan. But they gave you the signal and you chose to kind of move on from it. Whereas what Jen is doing is she's not going to move on, right? She takes a pause there. She digs deeper. She asks more questions. She tries to figure out what the issue is, because there is no point in moving on if the client is responding the way that I was responding, right? Something's off, and she was trying to figure it out. So I thought that was really good.
Thank you. So has anybody ever calculated the amount of coverage you need, Samir?
No.
Okay, that's fine. So this is how we help calculate it, because in the early days, most families have young children like you, high debt and little to no money saved, right?
Right.
If I were to ask you roughly how much do you have saved up between 401ks, other retirement accounts, and just your regular checking saving that would clearly go to your children, right? How
Yeah.
much do you roughly have saved up?
80,000.
Okay. And if God forbid something happens to you, would you want to make sure your children, by the way, what are your children's names again?
What did we say last time? Kim and Chloe?
Kim and Chloe, yes. So would you want to make sure Kim and Chloe's education is fully taken care of?
Yeah.
Okay. And if something did happen to you, you would want to make sure your debts are still paid off so Kim and Chloe don't have to deal with them, right?
Yes.
And just give me a rough number. How much of a debt balance do you have under your name between credit cards, car loans, anything with an APR attached to it?
Well, oh, car loan too? Yeah, 30,000.
Okay, good job. Not too much. How much are your bills roughly per month in order to keep a roof on Kim and Chloe's head?
My bills are $6,000.
6,000. Okay. So I'm gonna just magnify what you told me right now. You said you have about $80,000 saved up in cash, right?
Okay, I want to pause here because this is being recorded, and I don't want to mess up your rhythm here, but if we can go back to that, what are the questions that we are asking here? Okay, so when it comes to when the calculations start. Oh, great, you have it all here.
It's all memorized because I've done it so many times.
Yeah.
Yeah. So this is Shondell actually did this training with Shaq in an advanced training, probably like last year, and I just took it and ran with it.
Mhm.
And while I'll just show you guys something really quick. So the way that I memorized this was I have a setup where I sit and my phone is sitting in front of me. So this is my phone. I took it, went to Walmart and got like a $10 stand here to attach to my printer. And I put the slide of the theory questions on there so that I could read them while I was on Zoom, working on getting the client to move forward and getting the data that I needed to do a quote. So that's how I memorized the questions because they were just in front of me. While we're on Zoom, the advantage is the client can't see what you're looking at most of the time. So that's how I memorized that. And as I just went through the flow and I did more and more appointments, I didn't have to look at it anymore. But the slides are there. Shondell and Shaq did train on them. And I just used it instead of kind of never looking back at it.
Okay, that's a good point, right? You used it instead of watching the training once and then never looking at it again. That's a good point. So why don't we go back to that slideshow and just slowly scroll through it? That way, this is being recorded. They can pause, stop, whatever, as they watch this, right? So theory of decreasing responsibility, okay, starts with how much, has anyone ever showed you how to determine how much coverage you need? In the early years, we have high responsibilities, kids, debt, mortgage, but we may not have a lot of money saved up, right? So in total, how much do you have between 401k, IRA, emergency funds, your checking account? Because you're trying to get the client to understand that whatever amount of assets they have, it may not in every scenario, but it may not be enough to last as long as they need it to. So then they give you that number. If anything were to happen, would you want any money set aside for your kids' college, right? What are their names? How old are they? Now you can get very personal with them. So we want to know, do you want college? Because we're trying to figure out exactly how big that liability is going to be in case something happens to you, right? So if you want the kids' college paid for, you got 2 kids, it could be 80 grand each, 100 grand each, that's 200,000 right there, right? So as long as there's a disparity between what they have in assets and how much insurance they have, and then all the financial goals that they would want to accomplish if they weren't here, that disparity creates the need for the client to move forward. That is your job, is to create that disparity, right? And that doesn't mean that we're selling things to people that they don't need, but 99.9% of people, there is a disparity there, okay? So let's go to the next one. Would you want your debt or mortgage to be taken care of, right? How much would that be? How much is your mortgage? How much is your debt, right? And you're getting them to talk about it. Next. On a monthly basis, how much income would you need to take care of all your expenses? So you would need to replace, in this situation, I said 6,000 a month, and then you currently have, so Jen, here, you were adding up everything?
Yeah, so I'm just showing them the numbers that they gave me. Can you hear me?
Yep, I can hear you.
Yeah. So I'm just magnifying the numbers so that they can't go back to from what they told me. So I'm just gonna put it in their face. That's why I pulled the calculator and review it. You want me to do this?
Was that the last question here? On these slides, was this the last one?
No. There was a lot more, but I don't use exactly all of it.
No, only talk about what you use. I don't want to hear what you don't use.
Okay. So this is where you stopped me earlier because I was pulling up the calculator. So going back to the QA practice here. So Samir, let me just magnify what you told me. You said you currently need to replace $6,000 a month, and you currently have $80,000 of assets, right?
Right.
And then on top of that, you have $30,000 of debts. Is that right?
Right.
This is a very rhetorical question, but if something did happen to you tomorrow, how long would 80,000 last Kim and Chloe?
Not long. A year.
So can you see why we need coverage in the early years?
Yeah.
But 15 to 30 years from now,